Ready to start building a property portfolio, but not sure where to find the best investments? I'm Tom from Source, and over the last 10 years, I've identified hundreds of new investment opportunities for clients across more than 20 cities in the UK. In this video, I'll show you how to locate the right investments, secure the best deal, and breeze through the purchase process. At the end of the video, I'll share a hidden library of crucial insights, information that only financial brokers typically access, but it can be a game changer for finding the best properties. In the UK, buying and renting out any property is generally straightforward. The UK rental market is very strong, and we have a housing shortage currently of rental stock, but that doesn't automatically make it a great investment. Many investors buy something they got some sort of positive gut feel for when they viewed it. They buy it, they rent it out, and they think they're doing well. Often because they don't truly know what great actually looks like. For a living over the last 10 years, my job has been to identify properties for my clients that are in the top 5% of what is being offered to the rental market. Those that have tenants queuing up and future buyers eager to purchase. So what makes a property part of that top 5%? Let's break down the key ingredients. When choosing a location for an investment, the best investment locations, no matter what town or city they're in, provide tenants easy access to work and amenities. The requirement to be near work and amenities for the rental sector is the highest ranked must-have in a recent survey by JLL. Whilst investing in any of the major cities in the UK would likely pay dividends 5, 10, 15 years from now, if you want to really nail it, I also focus on areas that have emerging economic prosperity. In simple terms, that's where new businesses and jobs are coming into an area, creating growth and demand for housing. This isn't just about big cities. Often it's the smaller towns where one or two major employers or industries are moving in that really start to see rapid transformation. Take Rugeley, for example, a small town in Staffordshire. When Amazon opened one of its largest UK fulfillment centres there in 2011, it was a game changer. This single facility created thousands of new jobs, mostly in logistics and warehousing. The impact was huge. Local house prices climbed by over 20%, and rental demand shot up as workers needed places to live. It didn't stop at Amazon. The presence of such a large employer brought improvements to local infrastructure, like upgraded roads and better transport links, making the area more accessible and attractive. So when I talk about emerging economic prosperity, I mean looking out for those opportunities, areas where new jobs are coming in and pushing demand for housing. It's about finding the towns and cities that are quietly growing and becoming more valuable. That way, you're investing in locations with real potential for long-term growth. Next, let's talk about the property itself. One of the biggest tips I can give when buying an investment property is this: only pay for what you actually need. You don't want to overpay for features or extra space if they're not going to boost your rental income or capital growth. The goal is to keep your costs efficient, so let's break down the essentials. For one-bedroom apartments, I wouldn't pay a premium for anything over 600 square feet. In my experience, a well-designed 500 square foot one-bedroom rents for nearly the same amount as something bigger, so you're not really gaining much by paying more. Plus, the capital growth on these tends to be proportionate to the size, meaning you won't miss out by going with a more efficient option. For two-bedroom apartments, I also aim for efficiency. I'll generally go up to 800 square feet because, again, tenants won't necessarily pay more in rent just for that extra space. If you did try and proportionately charge more rent, you end up shrinking your rental market as less people are in the market for two beds at that size and at those prices. On the flip side, I try not to go below 650 square feet for two beds, as smaller two beds can lead to increased turnover. And if you're looking at houses, I recommend sticking to 2 to 3 bedroom terrace homes up to around 1100 square feet. This size perfectly meets the needs of the rental market without needing extra costs. It keeps your entry price efficient while still ensuring strong demand from tenants. In short, focus on what will truly drive rental demand and value, and avoid overpaying for features that won't pay you back. Once you found a property that looks promising, the next step is to check the numbers to make sure it's financially solid. Here are the 4 key calculations every investor should know, and the ranges that we would typically work within. The first one is gross rental yield, and the calculation is annual rental income divided by the property purchase price times by 100. Gross rental yields give you a quick snapshot of the income a property generates relative to its price without factoring in expenses. It's helpful for comparing properties at a high level and understanding basic income potential. For residential investments, we would typically aim for a gross yield between 6 to 8% if we were looking at a high quality location and outside of London. We personally find most investments presented at 8% plus come with risks that are not part of our long-term long-term investment strategy for clients at Source. The next one is net rental yield, and this calculation is annual rental income taking away annual operating expenses divided by the purchase price times by 100. Annual operating expenses include costs like property maintenance, service charges, insurance, and management fees. Importantly, this does not include mortgage or financing costs. The net yield gives you a more accurate view of the property's earning potential after accounting for all operating expenses. By excluding financing costs, net yield focuses on the property's own performance and helps you see what kind of return you'd get if you owned it outright. For net yield, we generally aim for a range of 5 to 6% or higher. This indicates solid profitability after covering necessary expenses, showing that a property can generate reliable income. The next one is monthly cash flow. And the calculations is monthly rental income, taking away monthly expenses, including mortgage, service charges, and maintenance. Monthly cash flow is the amount left over after all your expenses, including your mortgage. Positive cash flow is essential to keep the property sustainable and make sure it's profitable in the short term. The next one is return on capital. And the calculation is annual cash flow divided by total cash invested, which is typically the deposit plus the purchase fees times by 100. The return on capital shows your return based on the cash you've personally put into the property. This is especially useful when using finance as it gives you a more accurate view of how hard your invested capital is working for you. For return on capital, we usually look between 9 to 12% or more in year one. Higher return on capital means you're maximizing the return on your own money, which is what you want from a leveraged investment. At Source Investments, we've deployed our own spreadsheets, or series of spreadsheets actually, that break down these calculations for each investment that we work on, helping clients get a clear picture of the numbers before they buy. If you'd like a template to do the same, just get in touch using the link in the description and we'd be happy to send one your way. Next step is learning how to secure the best deal possible. Here are a few strategies to help you find, evaluate, and negotiate properties effectively, making sure you're ready when the right opportunity comes along. First up, know the true market value. Look at recent sales data for comparable properties in the area. This helps you see what properties are actually selling for, not just what they're listed at. It gives you a clear idea of fair pricing and leveraging negotiations so you don't end up overpaying. The next point is building relationships with local agents can be really helpful. It's not always a guarantee of getting the best deals because most agents will typically still share properties on Rightmove and Zoopla as opposed to off-market if they're decent quality. So it's more about staying registered with as many agents as possible and being ready to act quickly when something comes up. Just be prepared. You may end up with a lot of emails and calls coming from different agents, but it's all about staying in the loop and spotting opportunities as they arrive. Now, negotiating is something we see investors often try to do on their own, and it's easy to get too focused on getting the perfect price. Of course you want the best deal, but remember this is a 10, 15-year investment. If the property ticks all the boxes, don't lose the opportunity over a small percentage in the price. Missing out on a great investment over 2 or 3% here or there will be completely immaterial 10 years from now. So keep focused on the bigger picture. Most of the best deals aren't on Rightmove or other listing sites. So if you're finding it hard to identify the right investment, simply reach out to us and we'll add you to our investor list. You'll then receive and access all of our latest investments. Just check the link in the description to get started. First things first, before you even start looking for properties, make sure you're fully set up. Get your funds ready, have a mortgage decision in principle, and make sure your tax structure is all organized. I covered this in detail in an earlier video, but the key is not to be figuring out your setup when you're ready to make an offer. It's all about being ready to move quickly. Once your offer is agreed, try to tackle some of the more time-consuming steps straight away. If you can get the following done within the first 5 working days of your offer being accepted, it will usually set you up really well for a smoother process. Formally instruct your solicitor right away. Complete their questionnaire, handle the AML checks, and place them in funds for searches. Searches can take 2 to 3 weeks to come back, so if you wait 2 weeks to pay, your solicitor won't start raising inquiries for at least 4 or 5 weeks. The sooner this is done, the sooner you'll see progress. If you're getting finance, work with your broker to complete the full mortgage application and pay for the valuation straight away. It can take 2 to 4 weeks for the valuation to be booked, inspected, and reviewed by your lender, so don't delay this step. Keep in regular contact with your solicitor and mortgage broker with quick weekly check-ins. This can be as simple as a brief email or call just to catch any small issues before they become delays. Once you've done this initial setup work, you can take a bit of a breather whilst your solicitor and mortgage broker handle things on their end. Being organised right from the start and keeping in touch along the way can save you a lot of time and stress later in the process. In the final section, I'll show you how to access some hidden resources that lenders use to determine what they'll actually lend on. Insights that can guide guide you towards safer, higher quality investments. A great way to understand what makes a property safe from a lender's perspective is to look at the lending criteria of some of the biggest UK banks. To do this, just go on Google and search for the intermediary websites of lenders like Nationwide, NatWest or Barclays. Now, these intermediary sites aren't really designed for the general public. They're meant for mortgage brokers and professional intermediaries, but you can still access them and find the full lending criteria for each lender, including specific property requirements. This information can be really valuable. The criteria set by these lenders help steer you towards safer investments, avoiding properties they deem too risky to lend on. While they won't explain exactly why these criteria exist, just know they're developed by underwriting experts with access to huge amounts of housing data. Essentially, these criteria are built to protect the lender, but you can use them to guide your own property choices, giving you an edge as an investor. If you're ready to take the next step with your investment, don't miss the next video in this series, The Ultimate Guide to Letting and Managing Your Investment. I'll walk you through everything from finding the right investments to maximizing your rental income and keeping your property running smoothly.